Welcome to today's Explainer. We're diving right into the latest financial data from genomics giant Illumina. Now, if you follow the biotech space at all, you already know Illumina has been on an absolute roller coaster lately. We're talking intense regulatory battles and some major leadership shakeups. But recent earnings data suggest a massive, fundamental shift is underway. So we're going to break down exactly what the numbers are telling us, straight from the source.
But hey, before we get completely lost in the weeds of these earnings reports, we have to ask the ultimate question that's on literally every investor's mind right now. With their operating margins climbing out of negative territory just a couple of years ago to a really robust 22% in the first quarter of 2026, is the stock actually ready for a breakout, or are the macroeconomic headwinds in research and international markets just too heavy of an anchor?
To figure that out, we've broken this explainer into 5 quick chapters. The Illumina inflection point, powering the clinical engine, margin expansion catch-up, shedding grail and restructuring, and finally, valuation and future outlook. Let's get into it.
Chapter 1. The Illumina inflection point and those Q1 2026 surprises.
Right out of the gate, the company delivered a very solid $1.09 billion in revenue for Q1 2026. That represents a 4.8% reported growth year over year. But more importantly, it handily beat analysts' expectations by about $20 million. And look, when you're a company in the middle of a turnaround phase, beating that top-line consensus is step number 1 in winning back the market's trust.
You can really feel the internal momentum when you hear what CEO Jacob Thaysen has to say about this. He's pointing straight to the underlying strength of the entire Illumina ecosystem. The absolute key driver here is their flagship high-throughput sequencing platform, the NovaSeq X. They are successfully upgrading older machines to this new, hyper-efficient standard, and it's completely reinvigorating their core business.
But here is the craziest part of this beat. They pulled it off despite some frankly massive headwinds. Greater China organic revenue plummeted by a staggering 29%, and research market consumables dropped 12% just because of general funding uncertainty. But to power through that deficit, clinical consumables outside of China surged by 20%, and the NovaSeq X now makes up 90% of their high-throughput volume. So they're essentially using their sheer dominance in the clinical space to completely overpower those regional drops.
Moving right along to Chapter 2, powering the clinical engine and the core drivers behind it. When you break down their revenue pie, the dominance of consumables is just wild. A whopping 70% of their core revenue comes from consumables, compared to a mere 16% from the actual instruments themselves. Think about what that means. As they place more and more of these sequencing machines into hospitals and labs, it generates this massive, long-term recurring revenue tail. Every single time a scientist runs a test, Illumina gets paid.
And let me tell you, that recurring revenue engine is being fed aggressively. They placed over 80 of those cutting-edge NovaSeq X instruments in Q1 2026 alone. It's the ultimate razor and blades business model. Flooding the market with these new instruments virtually guarantees that those clinical consumables, which again jumped 20% outside of China, are going to fuel highly sustainable growth for years as those machines get put to work.
Which brings us to Chapter 3. Margin expansion catch-up, and how they are closing the peer gap.
Now, if you rewind just a couple of years, Illumina's margins had actually dipped into negative territory, and they were seriously lagging behind their life science peers. But today, they've clawed their Q1 operating margin all the way back up to 22%. They literally blew past Thermo Fisher, who sat at 18% for the quarter, and they are rapidly closing the gap with Agilent's 24%. It's proof that their cost structure has been radically optimized. And peeling back the layers of their Q2 financial statements, it becomes totally obvious that this is not a one-off fluke. Gross margins are sitting incredibly strong at 68.2%. But even better, the company generated a robust $162 million in free cash flow in Q2 alone. They aren't just selling stuff. They are successfully turning those consumable sales into hard, usable cash.
Because of this super strong start to the year, management has confidently raised their full-year non-GAAP operating margin guidance. They're now targeting somewhere between 23.4% and 23.6%. So they expect to exit the year running even more efficiently than they started it. And honestly, that is exactly the kind of trajectory that gets institutional investors drooling over a turnaround story.
All right, Chapter 4, shedding grail and restructuring those corporate moves.
Tracing their recent moves, the sheer speed of this restructuring is pretty striking.
They finally ditched the cancer screening company Grail in mid-2024, which removed a massive regulatory storm cloud that had been dragging down the stock. Then, by April 2026, flush with all that improving cash flow, they authorized a massive $1.5 billion share repurchase. On top of that, in August, they shook up the C-suite, bringing in a new chief commercial officer and chief legal officer. This is a management team that is actively optimizing for the future, for sure.
Vacen's mandate here is crystal clear. The whole messy regulatory nightmare of the Grail acquisition is officially in the rearview mirror. Now, the absolute focus is 100% locked on operational excellence, serving their core clinical customers, and, crucially, maximizing returns for the shareholders who actually stuck around to weather the storm.
And finally, Chapter 5, Valuation and Future Outlook. The big question, is ILMN actually undervalued right now?
Well, running the numbers through data models from the financial platform TIKR paints a pretty compelling picture for upside. With the stock hovering around $162 after earnings, their mid-case scenario, which just assumes clinical growth sustains and those margin targets are met, implies a massive 83% total return, pointing to a $228 price target. But if they hit their high case targets by accelerating that NovaSeq X transition even faster, the model suggests an incredible 124% upside. That would push the stock toward $365 by late 2030.
So let's pull all these threads together. Your major takeaway today? Illumina's margin expansion is totally real and structurally sound. The clinical sequencing business, which is driven by that razor and blades model of the NovaSeq X, is entirely carrying the load right now. However, as a smart investor, you have to remember that research funding drops and Chinese market declines are very persistent risks that management still has to navigate.
We've mapped out the financial DNA of Illumina's corporate turnaround today. The numbers show a much leaner, highly profitable machine dominating the clinical space. But at the end of the day, you have to make the call. Is this the perfect entry point to capture that projected upside, or are there still just a few too many missing links in the macro environment for your taste? Thanks for joining me on this explainer, and keep questioning the data.